Please welcome our moderator, Jennifer Jordan Saifi.
If I can, I'd like to introduce our panelists to join us. Marc-André Blanchard. Vera Songwe. Jennifer Morgan. And Keith Svensson.
Hello, Jennifer.
Thank you so much for joining us today. I thought it would be helpful if we just start off with a round of introductions on who we are, so everyone in the room can understand. And obviously today we're going to be talking about blended finance and sort of where we are, what's the cutting edge conversation that the world is having, and the various roles of the private sector, multilateral institutions and governments as we really try to accelerate the transition to a sustainable future. So my name is Jennifer Jordan Saifi. I am the CEO of the Sustainable Markets Initiative, which was founded by His Majesty King Charles III in 2020 when he was the Prince of Wales. And we're a leading group of over 300 CEOs from across industry and finance globally working on this transition. So perhaps, Jennifer, I can introduce you and you can...
Sure, I'm Jennifer Morgan. I'm the Special Envoy and State Secretary for International Climate Action right around the corner here at the Federal Foreign Office. So welcome everyone to Berlin.
Nice.
Wonderful. Marc-André.
I'm Marc-André Blanchard. I'm an Executive Vice President, head of CDPQ Global and responsible for globally for sustainability at CDPQ, which is an institutional investor in the province of Quebec, one of the second largest pension fund in Canada. And I am chair of the Blended Finance Task Force with the Sustainable Market Initiative.
Wonderful, thank you. And Vera.
Vera Songwe, I'm co-chair and founder of the Liquidity and Sustainability Facility, essentially trying to intermediate finance between emerging markets and developed economies and lower the cost of capital. I'm also the co-chair of the high-level independent expert group on climate for finance action.
Wonderful, and Keith.
Yeah, my name is Keith Svensson. I work for AP Moller Maersk, and which is a leading transport company of the world, and I am the CEO of the Ports Division and invest in a lot of infrastructure around the world where this is a current challenge.
Amazing, amazing. Well, we've got a really wonderful group here, and I'm sure we're going to have some very diverse perspectives. I think one of our objectives here is also to identify some concrete recommendations and actions. Again, everywhere around the world is talking about blended finance, but if we really want to accelerate, what do we actually need to do? So, if we can try to be as concrete as possible, that'd be wonderful. And maybe, Jennifer, we can start with you, because I know today you actually announced some of the work that you're doing on the Green Guarantee Group. Could you share us a little bit about that?
Yeah, absolutely. So I guess the impetus, and we've known that the cost of capital issues are large for some time, but I have to say I was very inspired last year when I was at the Africa Climate Summit, and we started working closely with Kenya and a number of other countries in Africa because they launched something called the Accelerated Partnership for Renewable Energy in Africa. And came back home from that, and with the team said, okay, how do we tackle this cost of capital issue? And some research that had been commissioned kind of looked at guarantees as an instrument as being very important, but quite underutilized and quite fragmented, and in order to deal with the perceived risks across the board. And so what we did was we started convening different actors in the financial sector and thought, okay, let's create a Green Guarantee Group in order to bring those best practices together and to get more transparency around it. So really looking at how to bring in more of the data that is needed in order for more transparency there, how we can actually be looking at what are the different standards that are there, how we could bring forward some lighthouse projects working with countries, so really seeing what are their priorities that are there. And we also, this is something led by my ministry, and the Economics and Climate Action Ministry, working, of course, also with BMZ, but then we asked Henrik Röhle, who is Chancellor Merkel's Sherpa for the G20 and has a lot of finance experience, to come in and be our champion. So today we just had a session to really kick this off. We want to raise it up on the political agenda. We know the World Bank. I mean, everyone who is in the mix, we don't want to duplicate. But we have a sense that if you're sitting in a country looking at this spaghetti, that it would be helpful to untangle it and match it in order that we can be lowering those costs of capital in a tailored way, recognizing it's not the only instrument that's there, but that hopefully then we can get some of these investments moving from the private sector into the places that need it the most.
Amazing, wonderful. And I think, Marc-André, I know you're also Canada's ambassador to the UN some time ago, and we talked about blended finance in the context of the SDGs, and increasingly we're talking about it in the context of climate. What are you seeing, and how is the private sector really leaning in to help governments with this effort?
So I was at Climate Week last week, and really blended finance was a big talk of the town. And actually, I was so glad because when I was ambassador, I started to talk about this, and that's in 2016. So the fact that it's now being mainstream is a good thing, because blended finance is needed in both emerging countries, but also in developed countries. I mean, we forget that part, but like it's a big thing as well, because there's a lot of the infrastructure we need to build for the transition. The risk-return equation for a fiduciary, for an institutional investor that has fiduciary obligation like us, it doesn't fit. So we need instruments to actually de-risk ourselves and get it right. So I applaud the Green Guarantee Company that you're putting together. I think it's right in the right direction, because in the last year we came the private sector together, whether through the Sustainable Market Initiatives and then through other institutional coalitions like the Investors Leadership Network and the GISD. We said, what do we need? And we need concessional capital to get the risk-return equation right. We need, and one of that is actually, it goes obviously to the geopolitical risk, call it the country risk, but then the currency risk is a big thing. I mean, it has been at CDPQ, we invest in emerging market, and the currency risk has been probably the biggest factor in actually reducing our returns from emerging markets in our experience of the last 7 to 8 years. And then you need project preparation. I mean, like there's not enough project at scale for investors like us. If we want to move from billion to trillions, we need scale, and then we need data. And so we had been pushing for a long time with the World Bank and the MDBs to get the GEMS database available. It's now available, but it's not. It is getting there, but it's in a language that is tough for us to get access to, and so we're going to work on that. And then you have the regulatory, Basel or 3 or other regulatory framework that we have around the world, whether for pension funds in Australia, they cannot invest outside of OECD countries. And then you get the Basel 3 regulation for banks, and the same thing for insurance companies that are limiting. So we know what is needed. We're all working in that direction. We're creating some instruments, and I'll finish on that just through the SMI. I was at a discussion last week I never thought I would have that discussion in New York. Larry Fink and Jim Coulter and all of the Uzu of Wall Street were around the same table. They all came to the UAE mission because of the Altera Fund, because the UAE during the last COP has announced 30 billion set aside for all sorts of capital in the context of the transition. Part of it being catalytic, and part of it then for blended finance. And so it was interesting. Larry Fink said, well, you know, blended finance is like making bread in my own kitchen. I can only make one thing at a time, and you don't know how the bread will come out of the oven. The other, Jim Coulter said, from TPG, is a private equity leader and guru in the US, in the world, and he said, well, the solution is in blended finance. We need blended finance to succeed, even from a private equity person. I never thought I would hear this. But he said the problem is investors are not aware that it exists that much. Actually, they don't believe it's at scale, and they don't believe that they can do it. It's too complicated, and all of that. So what we did a year ago, and I'll finish on this, is that through the Sustainable Market Initiative, we said, well, we have a real problem of communication here. Nobody knows really what it is, blended finance, and what form it could take, and what are the instruments. And the other thing is, we all, when we start, we all start from scratch, and we try to build it. So we've put 13 of the best cases together. And with the details of the structures, those of you who are lawyers and stuff, or bankers, go on the SMI, on the Sustainable Market Initiative website, and you'll get access to it. It gives you the recipe for each of these 13 best examples. And they go from 50 million to 2 billion. And they go from Africa to Southeast Asia to Montreal, where we have a blended finance. We are financing a light rail train with blended finance. So for us, it's all about, you know, now it has come, but the issue is how will we scale it and what kind of instruments we need. And the toughest part of all of this is to get the concessional funding available. That's been our experience, and that's where countries need to think about, the G7 countries, the G20 countries need to think about that.
Thanks, Marc-André. So like in the SMI, we have an experience where we work with industry, finance, and countries. One of our target markets, obviously G7, G20, but also the Commonwealth in particular, where we have a lot of emerging and developing markets. And one of the first things that we did is, ask the countries, how can the private sector help you? How can we help invest? How can we have industry partners to help you transition your various industries? And what we often got back was development type of projects. And these don't align with what investors are looking for, which is sort of where the blended finance comes in. And we've developed a number of tools. But Vera, with your experience in emerging and developing markets, like if we're thinking about one end of the pipeline and then the other end of the pipeline, how do we get them to meet in the middle?
I think that's a very good question. And I think three things on sort of the blended finance space and development is, because development in and of itself is already quite difficult. I think one of the things, and I really congratulate the work that has been done by SMI and putting out this case studies. I think the next step in the case studies is standardization and scale. Yes. Standardization is the key, because if every blended finance project is different from the last one, we will never get to scale. What we need to do is agglomerate those projects, figure out if we're trying to do renewable energy in this jurisdictions, these are the 7 things that you need. If you have them, you're good to go. And then we could have platforms, because essentially in the emerging market economies, you don't have large enough markets. And so what a CDPQ is looking for is agglomeration, so they can come in and take a slice of a $1 billion pie. But if you have one blended finance project in Ecuador and another one in Cote d'Ivoire and another, and each one of them asking for a different legal framework, CDPQ can never come in, even if you're putting all the resources to blend. So I think as we grow up, one of the most important things for the blended finance space is to see whether we can standardize these projects. The minute you standardize, then I think a lot of the conversation about not enough projects, not enough bankable projects to finance goes away, because then we can bring them together on platform scale. I think the second one is what you mentioned, is really the development cost. A lot of the problems happen at development stage, including, by the way, in advanced economies. And that's where you need the blending. That's where you need the first loss money. That's where, because it's a lot of behind the border problems. It is the regulation to install, it's the land rights, it's those kinds of issues that are best done with long-term patient grant capital that you can put put to work. And I think, again, we need almost a taxonomy of what does this look like. And if you have a series of investments that fit that, then you should be able to deploy. I think the most important now that we're beginning to see, and Marc-André talked about it very quickly, is the Basel prudential regulation and the jurisdictions in what you can do what. So today, even if, and congratulations, by the way, on launching the Green Bank, I think what we see is, because securitization in 2008, led to the crisis, any kind of securitization today is looked upon and frowned upon by our prudential authorities. And so a guarantee is considered a securitized instrument. And so the MDBs or any multilateral development institution, even though they have a AAA credit rating, are still penalized when they deploy these kinds of instruments. And I think one of the things that we should ask, big shareholders like yourself, is to see whether we can distinguish under Basel regulation between multilateral development institutions, bilateral development institutions, which come with a AAA rating, and the savings and loans or corporate insurance fund in California. They should not be treated the same, because then the guarantee product, which is so essential and so important for de-risking and for blending, is not being used as much as it should be, because regulation is penalizing its use. And I think we need to work on that. And finally, I think Marc-André mentioned FX. The biggest problem that we have, and we don't yet have a solution for it, to be honest with you, the best solution for FX is blending, but it's to blend with local currency vehicles. And so essentially, in these environments, we talk a lot about blending, but always still blending and de-risking with foreign currency. But I think it's become critically important for a lot of this blending to work with local pension funds who can take development risk, who can take early stage risk in local currency, so that by the time you get to where you're getting an ROI that is important and interesting for investors, you have actually taken away much of the risk that is entailed in the investments that we're making. And I think the work between external pension funds and domestic local pension funds is so important, because pension funds are the cheapest long-term capital that you have. And if we can bring that into this blended finance conversation, and I'll end by saying that one way of doing that is to work with national development banks. And if you look at the BNDES, and we're writing a report on for the G20, and you just see the work that BNDES is able to do in Brazil with local investment, blending the real with foreign capital to achieve what it is achieving, then you begin to understand why they're doing as well, because they have long-term patient real capital that does a lot of the initial investment. And essentially what they're now doing is asset recycling. They develop the project, and then and essentially de-risk all of it, and then they resell it. And so a lot of what CDPQ or GIF is doing is essentially rebuying the airport, and the airport is already done. And then you can take those resources and invest in something else. And my sense is this is what we should be going towards as well, is getting international capital to work more with local capital. First of all, get them to comply with international regulations so that we can bring in that capital. But then once we have that, then see how we deploy first local capital to make sure that it becomes the first point of blending to make the projects much more interesting.
Thank you. Excuse me. I think one of the other parts of the conversation is, we talk a lot about like moving from billions to trillions. It's been, the past 5 years has really been dominated by financing the transition. But we often forget about the importance of industry partners, because that finance has to go somewhere, and you gave us some good examples. I know, Keith, you're working in one of those industries is a real economy industry. How are you seeing like the way to incentivize and de-risk from a purely private sector perspective?
I think, first of all, there's a lot of hope in some of the things that has happened just in the recent past. We work in global transportation, and if you go back to the 80s, there was not global markets to the extent that we're looking at today. And basically, the entire infrastructure that fuels global trade has been created through public-private partnerships. And so I think we have the instruments. If you can do what you just mentioned, and combine that to instruments like a concession or public-private partnership, where you take very long bet on some of these large investments that has to be, then we know how to manage in that world. So in our case, we do shipping, logistics, and ports. Our ports are typically 25 to 50-year bets. They're all over the world, from Nigeria to Sweden to Brazil to anywhere on the planet. And we live with these risks every single day. And we develop them, and then we hold them. We then sell them. So we get to live through the cycles. And I think some of these very large FX movements up or down, the trade that moves up or down, the prices that moves up or down, the volatility in global politics is a reality of this business. But we have found ways through great work that's been done by the World Bank and by a lot of people 40 years ago on finding ways to actually make instruments that can handle very long money and very large investments in very volatile investment. And it happens to be a good industry also for the owners. So I think there's some learnings in the public-private partnership and concession model also to solve the energy transition.
Amazing. And Vera, if we want to switch a little bit now to really focusing on concrete actions. I mean, you've talked about standardizing, and I think it's also aligning with for me it's which countries are ready. You talked about making sure that from a regulatory perspective things are aligned, right, and that they're ready to receive the capital and receive the partnership. Where do we start in a very practical sense?
I talked about asset recycling, and almost every emerging developing country has an asset. I think we heard this morning from Larry and that the public sector should not be managing rail stations or airports or bus transit. And so if you went into any one of those countries, you will find an airport that you could concession, you could find a railway that you could concession, you could find a port that you could concession. That's where we should start, because those have already been built. So the risk is almost, brought down to 80% of the risk has been taken away, because a lot of it is construction risk. And I give you a very good example. If you look at the Dakar toll road, Senegal, initially when that road was being built, we thought it's going to take 30 years to get a rate of return. It took 8 years. And so essentially, concession it out, use the resources from that to do another one. I think there's a sense in the developing world that, you have to build and hold. And essentially what you should do is build and offload, get the resources and go build the next thing, particularly in a world where there is such scarce capital. And I think that's where we should start. I think if you do that, first you can standardize a little bit asset recycling regulations, right? This is much easier to do as opposed to doing something else. The second thing is, again, standardization of the instruments. And clarity. I think Marc-André talked about the GEMS database. I think there's this risk perception issue, and the more data that we can have in terms of the 80 years of the Bretton Woods institutions, 80 years we've been investing in development, we have a sense today of where are the countries where you can make gains, where are the countries where you cannot, what is working and what is not. So 80 years later, we cannot be asking the basic questions. In an age where data is so easy to get, I think there's a couple of things that one can just standardize in terms of access, in terms of risk-adjusted returns and what we're looking for, and make them public. And finally, I think one of the areas where there is a lot of miscomprehension is every development leader would tell you, I have 15 projects, 1,000 projects. And then you talk to Marc-André, and Marc-André says, I cannot find bankable projects. and this is a disconnect, and it's because the standards are different. You're looking for something, and they're looking for something. And if maybe with SMI and G funds and the others, and I see Bongolo and many others here, we could come together to say, how can we standardize? When you say bankable, what are you looking for? What is the kind of blended financing that you need to make sure that the project moves from development project to an investment where I can put real equity into it? Then I think we will have a conversation that is much different. And so I think those are really where we need to go. First is just use your existing assets, recycle them, don't hold. We're asking the IFC and the World Bank to mobilize, to distribute. I think once they, so as we're saying, mobilize resources and distribute the investment, I think countries should also build to distribute. And if you do that, then you have the two sort of meeting and talking to each other in a much easier way. Secondly, standardize the data. We have the data that we should use. And then this project development conversation, again, I think getting the project developers and those who are looking for the projects to see whether we can standardize them, bring them to scale, and create maybe a platform, an exchange, where you put all the projects and those who want to buy and sell can then just talk to each other directly.
Amazing. Thank you so much. Really, really practical. Excuse me, Jennifer. From a government perspective, when you sort of hear whether we need to be standardizing, putting more frameworks together, having platforms that the countries, the investments are talking better together, whether it's the Green Guarantee Group or other aspects of what maybe the German government and other G7, G20 governments can be doing, how do you think we should be practically tackling this and sort of building on what Vera was talking about?
I mean, the recommendations and what you're saying, I think makes huge sense. And I think we're learning a lot. And I think the challenges on the uptake of guarantees and the different pieces that you've mentioned, I think are now on the list to see, okay, can this Green Guarantee Group be a platform to do that kind of work, to do the standardization, to get the data availability that's there, to also really be looking at the various and varied reporting requirements that are there on the complexity and the accessibility, so that it can be much more transparent in that way. The other piece I was curious about or wanted to bring in that we do quite a lot on is actually looking at how to match the national enabling conditions together with the finance. So whether it be learning a lot through the Just Energy Transition Partnerships, where groups of countries have come together, the first one kind of emerging from South Africa, on saying, okay, we would be, here's our thoughts on how we could accelerate a just transition away from coal, accelerate up renewable energy, and okay, G7, what are you going to do, right? And so where we've been in, there's an investment plan, we've been in a journey now for a while. I was just recently there, and what I can see is kind of, we've been engaged and partnering with South Africa for a long time on policy-based loans. And now you have a Climate Change Act that now the new government has passed, or actually it passed beforehand, but the president has made really clear they're moving in the direction of looking at their nationally determined contribution and how much they need to be combining their just energy transition with avoiding and reducing emissions. You have an electricity regulation that's about unbundling and actually lifting caps on renewables that were put in place, and then the private sector came in. So I think bringing these different pieces together is quite important, because then you can start to see, like you were saying, okay, if we're growing renewables, then what is the key piece here? We can see, okay, Eskom is now moving forward in a different way. Okay, what can we be working on, or what could KfW be working on a highly concessional loan in terms of transmission, because the grid is so important? What can we be doing in terms of building skills for that green economy? And I think, in a way, I don't know what the right word for it, but it's like these series of building blocks that we need to be bringing together on this finance side and on the policy side in a way that is at scale, has the standardization in it, but also the demonstration in it. So that, and these country platforms that have been around for a while, making sure they're really country owned. It's the only way, obviously. And then seeing how do we leverage these different pieces. I think it requires the type of collaboration, which is, it's challenging, but it's what we need to do when we're trying to tackle a problem that has all sectors, is about development, economic prosperity, finance, and that's where I see some more of the, and bringing together the different potential investors in that to build the confidence and the long, loud legal signals. The final piece, I think, is on the nationally determined contributions that are coming up. I just wanted to make sure everyone is aware of those, because I think there's a lot of work happening right now to turn those into actual investment plans, or maybe not as detailed as an investment plan, but basically saying, okay, here is our pathway as a country to our net zero, whenever that is. Here's what we're thinking 2035 and beyond, and here's the different policy frameworks that we're thinking. And I was in a lot of conversations last week as well in New York on blended finance, but also with private sector on what are they looking for in order to fund these NDCs, which is absolutely imperative. So getting those to be much more about economic prosperity plans, investment plans, and translate, in a way, it's like a translation exercise of these different worlds, I think is key. And the work of the G20, the expert group, bringing together the climate and the finance communities, I hope that that can continue under a South African G20 presidency, however they wish to do that as well, because I think we need these worlds to be working together, and that hasn't been happening enough in the past.
Yeah, I mean, if we think about sort of the practical alignment of NDCs, and we've been looking at NDCs for a long time as we again try to align the industry and the finance to help countries achieve their objectives. I think it was really great news to say that they want to now have an investment strategy alongside these renewed NDCs and higher levels of ambition. But if they're not done with the private sector, we're still going to be in the same exact place a year from now.
Yep.
So I think as an action, like we need to say, we need the private sector in the room to help you develop these investment plans, to help the standardization. There's a really great window of opportunity for us to really sit down together and hopefully take a few key markets from each region of the world and really do that standardization that can then be rolled out. But did you want to come in on that one?
I think that's a very good point. One thing that we're struggling with, and we're pushing in the G20 report, so we hope we get support from Germany on that, is that for the NDCs to become transition strategies and then be invested in, you almost need an agreement on taxonomies. And right now, we don't have an agreement on taxonomies. And so the financial system, of course, is working really hard to get a taxonomy on sort of what is financial risk, what is fiscal risk, and how we invest in it, and how we create capital buffers. But if you are not able then on the development side, sort of the investment side of the transition plans, to also have interoperable, so we don't want harmonized, but we want at least interoperable. So if you're from the Philippines and I'm from my Ivory Coast, I can say, this is the risk. Because it's only when the financial system has put a risk on it is CDPQ going to come and throw its money behind it these days, especially given Scope 1, Scope 2, and Scope 3. And for the developing countries, I think there's a huge risk that if we don't have interoperable taxonomies, the financial sector will run away because they don't know whether we're greenwashing, whitewashing, and they'll say, I cannot touch that investment because I don't know how to classify it. And this, for me, is probably one of the most critical risks for investment in low and emerging market economies coming down the road, because the big investment houses will say, too difficult to do Scope 3. Scope 3, by the way, is when you report on the investment of your investor. So it's 3 levels removed from you. And so what we are seeing is many financial centers are cutting themselves off of that level 3. And that level 3 is a lot of emerging market and low-income countries who have not yet been able to do the kind of reporting that is needed for the financial system. So I think this is so important that we push interoperable taxonomies, harmonize them a little bit, and so the low and middle income countries can actually then integrate that system. Otherwise, as much as we put the blended finance on the table, the big investors will not take it and put it in our destinations. It'll end up in maybe the middle powers who are able to do reporting better than the rest of us.
Yeah, I want to come on, it's complementary, because I agree with everything that has been said. The recycling point of assets is very important. It sounds like a boring idea, but it's real, and it has. If the World Bank, the MDBs, and the countries were really recycling their assets, I mean, some countries do it very well, like India, for example, and we participate in that. We're very engaged. So it would be, Indonesia started to do it, but other countries need to do it, and partially the MDBs need to do it. But Jennifer, you have a key role with a big G7 country. I have a big plea to make to you. it's you know, the piece that is missing the most when we try to put platform together, the toughest tranche of capital to get is the de-risking, either for the FX or the first loss. And last year, the UAE put 30 billion on the table. I understand it's a rich country, but one country put 30 billion. Now I've participated in the works of the B20 in Brazil, and I thought the group came on the infrastructure and finance track. They came with a very original idea that actually I believe is something that the G7 countries like Germany and Canada should really pay attention to. They've said, we need 75 billion. They work with Convergence, which was a creation through a G7 creation of 2014, I think. And they came out with that number that it would take 75 billion per year for 5 years to create a substantial pool of concessional capital for the world. Whether the number is right or wrong, it's not the point. It's the idea for me. And when we're talking about at this COP, we'll be talking about to renew the Copenhagen objective of $100 billion of governmental money for emerging markets. I know we're amongst us and nobody listens and all of that, and it's a private conversation.
Very private.
I actually believe that counting it this way is to the detriment of G7 countries. Because what G7 countries bring to the table is so much more than that 100 billion. It's the private sector. So the G7 countries need to stop counting like other countries who don't believe so much in the market economy and start counting with real free market, like real free market economies count. And that's with the private sector. So the goal should be 75 billion or another number that you want, but to catalyze the private sector. And you're going to multiply that number by 3, 5, or 10 times. And that's a real game changer, because I don't like the 100 billion, because the South says to us, oh, you're not meeting the 100 billion, then the trust is not there. I mean, Canada's share of that 100 billion is usually $2-3 billion a year. In the last 7-8 years, we've probably put $5-8 billion in emerging markets as a country in climate. Well, if you calculate all of the pension funds, just the pension funds, what we've been investing in emerging markets during that period is probably 50 to 60 to 70 billion. That's the amount for Canada. It's not 5 or 3 billion. And that's what we should be talking about. So I implore all of my friends who are at the table for G7 countries to actually note, and I was happy that actually at the B20, it came from Brazil as an idea. And I think it's a great idea. And I believe we should, because we need to change the conversation on that.
Totally agree that we need to change the conversation. We're trying to change the conversation. And I think these types of ideas are what we need right now. So it's clear that, I mean, there's lots of different pieces of this puzzle, right?
Yes.
So it's our responsibility as developed countries to be continuing to lead on providing public finance. But it's so much bigger than that, as you say, right? So I think the conversation now is around, okay, what is the big number on the global investment goal, right, which has come often from HLEC, right? And then, okay, what are the different levels? You can think of them as layers in an onion. You can think about it like you're playing darts on a board. And what can those different levels be delivering? Yes. Right? So yes, we need public finance. We think we would like to continue on that, but we think that there are new countries that need to come in because they're wealthier, they've contributed a lot to climate change, and so we'll have that conversation. But that's an important conversation. But I agree that it's not really what's going to change the world. What's going to change the world is getting the private finance, this link, right? So what is the level, what is the layer, and what's the mechanism that would actually leverage that? So is it a concessional finance pot? Is it a leveraging of MDBs to private, setting targets for them? Is it new innovative mechanisms? That's another layer in the onion to be bringing in. What is it on debt? To create fiscal space on debt? What is that whole conversation there? So that we can be having that conversation rather than only this one. And I think we're up for that conversation. We're in the middle of it. And my gosh, Canada has the G7 next.
Yeah, I agree with you. And I'll be advocating for this. But the importance is, I'm all in favor of public financing for the transition. But then I actually believe that we should talk about it as being a catalyst rather than being the end. And I think our partners in the South will think it's actually a fantastic thing because they want us to be there. They want us, the private sector, to partner with them, and way more than it is actually taught in some corners of the public sector. And the other point you've made, I think it's a very important point, Jennifer. I'll very quickly. When I arrived at the UN in 2016, Ban Ki-moon said to me, we don't have many people like you from the private sector. We just signed the Paris Accord and the SDGs, and nobody's talking about financing them. So he said, could you just help us change a bit the focus? Because everybody focused on ODA, and at the time it was 150 billion, but we need 7 trillion to achieve the SDGs. So there's a little gap here, and nobody is talking about the gap, everybody's talking about the 150. That was in 2016. I created a group. The group of ambassadors were the Friends of Financing the SDGs. 75 ambassadors, North, South, mixed. Second meeting, there was a BlackRock person. That was the only person I could convince in all of Wall Street to come and talk to 75 ambassadors, because at the time, nobody would, At the end, I'll remember this. The ambassador of Mexico stood up and said, we need a translator here. We understand nothing of what you're talking about. That was in 2016. And Jim Coulter, last week in New York, from TPG, said exactly the same thing. We need a translator. You see, here, the public sector and the MDBs and us and the private, imagine a private equity guy, we don't know, we don't understand each other. So we need to work on that and to continue, because it's a big point, because that's how, and that's why we this practice, because I'll finish with one other example. Investors, it's bottom up in most institutions. Big plans per country, most institutional investors don't really buy into this. What they buy is into opportunities. They're opportunistic about opportunities, and that's key to understand that of how they work. So we need to actually. This is why the book is so important, because it's going to show my people at CDPQ that, you know what, Allianz, one of our peers, is actually building such platforms. BOV, one of our main banking relationships, it's actually having 3 platforms like this, and all of that. It's easier to sell with our traditional partners than actually going with new partners. And that's a very important point to remember. I remember we tried building the best, what I thought was the best platform, but it was with unusual partners. And our investment committee would not buy into this. But they bought into joining Brookfield and Altera just recently for 200 million in a platform that would actually do almost the same thing. Because you know what? They believe in Brookfield. Brookfield is a traditional partner, is one of our main partners at CDPQ. So this is very important. So our role in G7 countries is a lot about that as well. And we need the help of government to convene us. And I'll really finish on this, is that...
You're not going to finish. Yeah.
Come in.
Please.
No, but that's...
And I want to get Keith in after.
I want to say one thing which is so important, because we are talking about blended finance. One of the things that we are seeing, and again, unfortunately, you're a G7 country, so it's good G7 and G20. But as we deploy blended finance to emerging and low-income economies, we are struggling with the exceptional subsidies and high interest rates in the developed world. Yes. And so if we are struggling to get a rate of return that is commensurate today with the 7%, 9% that you're going to get in the United States, and an IRA subsidy, which brings it to 18, 20%, we are in trouble. And so essentially, what we either have to then decide is to say that as G7 and G20 countries, as you de-risk us, if you're creating risk for us by creating subsidies in the same sectors. And so while you de-risk an energy investment in the United States, you have to then double the de-risking quotient to get somebody who is going to go do a solar plant in Nevada with an IRA subsidy and 2% to 5% interest rate in the United States to try to go to India or Cote d'Ivoire or Cameroon. That person is going to need a much, much bigger chunk of de-risking. And so I think that what we need to then begin to look at is this kinds of financial market distorting policies, because we've always talked about trade distorting policies, we talk about tariffs, but today, in this day and age where the emerging markets are coupling in the financial space with the developed and advanced economies, these kinds of financial regulation that create an uneven playing field essentially wipe away all your de-risking. We're back to square one. And so we do need to understand what are we going to do. And maybe what you do is double de-risk, your domestic companies. It will create imperfect competition for local companies in the emerging world, but maybe that's a step forward. But my sense is, I think, particularly in the energy space, where we have competitive markets, including in developing economies, providing the kinds of subsidies that we see to developed economy businesses, essentially wipes out the market for developing countries.
And I really, we're running out of time a little bit. We do want to see if we can get some questions from the audience, but I think that we also need to remember that the transition, you were just mentioning the energy transition, but shipping is transitioning, aviation is transitioning, every major real economy sector is transitioning globally. It's not country by country, it's like holistic. And this is happening in parallel to this finance conversation. And I hate to say, like I remember 2015, 2016, and I sometimes feel like we really haven't, it's 10 years. We can't wait another 10 years. 2030 is 5 years from now, so what are we actually going to do concretely? And we have to marry up the global market transition of real economy players with the finance conversation. So, Keith, shipping is real, it's related to trade. We also have to make this real to people, because the financing conversation doesn't evoke any level of passion or change in ordinary citizens and consumers around the world. Aviation is something you can get your head around. I've heard different statistics of if Nike added a couple cents to their shoes and traded that globally, we could help transform the shipping industry. And consumers could get involved and say, I want to pay for that, because increasingly consumers and young people are very passionate about contributing to the transition that needs to happen. So how do you think we can plug this in and sort of make the real economy dovetail with this finance and then impact people so that consumers can be active players as well?
If I can try to make it practical to my industry, right? So we're involved in aviation and shipping and logistics, which is trucking and warehousing and trains and then imports. And some concrete things we can do. I think the good news is, just to start by answering your questions, there seems to be about 20% of the world's customers who feel exactly like that. And there's products they can buy to take the carbon footprint of their logistics away. If we have to take sectors of the global economy like transportation and decarbonize it, and doing it at a pace that is significantly faster than what we've been talking about for way too long, it needs some really practical shifts, and I think financing is one of them, but it's only one. I think that it starts with some of the learnings we have gotten from, for instance, the First Mover Coalition, which we are founding member of, on what demands does we send out to vendors on what contract is associated to what we want to purchase. So Nike could do that on their shoes, and they actually do. But it could also be a government who says, I will grant this asset and I'll recycle it, but part of the demand is it has to be green.
Yeah.
Today, there is no correlation between, actually I would say the developing world is much more conscientious around the energy transition than right? So when we go and bid for a concession, for instance, there's people who, this is a demand, you must solve this problem, and then I will solve it, and my competition will solve it. Other places, it's like, no, let's not. How much money can I get, right? Yes. And I think it starts with a level playing field where governments and we start setting just higher standards for what we are buying. And I think I think that would accelerate. That's one practical thing we can do. If you take transportation, it needs an obscene amount of energy to power the world. A lot of new fuels for aviation, for ships, a lot of electricity for the rest. And all these investment appears to me to be very long-term infrastructure, utility-type investments. I think the concession idea is another practical thing we could get started with quick. And the last one is these mechanisms for how do you create level playing field. So the transition cost is real. So how do you start taking money from the old economy and putting over to accelerate the industry curve and cost curves on new fuels, as an example. And there's some really good proposals out there. I think decision-making would be a really good idea, so we can get going, actually. And then I have high hopes into capitalism will solve these industry problems as long as the incentives are right. And maybe for the first time in a long time, very hopeful also with some of the proposals that's out there. But I think actually doing and acting rather than continuing to admire the problems and commenting on the problem would really be, I think, appropriate at this particular time.
Very, very welcome, indeed. We're just talking about young people. We've got one of our BGD young voices asking us a question. Please go ahead.
Good afternoon. Thank you for the very insightful discussion. By way of introduction, I'm Jefferson. I'm now doing a dual degree program from both London Business School and Fudan University. So we talk a lot about the structure and design of blended finance and the PPP project this afternoon. So if we go back to the characteristics of both the public sector and the private sector, those projects like renewable energies might have a long period of return, for example, maybe 10 years or even 20 years. And the private sector, however, they might have to focus more on the short to medium term. For example, corporates, they might need cash to operate. If we come to those financial sponsors, they might only hold a company for like 5 to 10 years. So what can we do to bridge the gap between the characteristics or preference between short-term and long-term between these two sectors? For example, maybe we can design some mechanism like auctions, renewable auctions, to accelerate the monetization period, or we can design some more flexible financial instruments, something like that. Thank you.
Vera, did you want to come on that?
So I chair and founded the Liquidity and Sustainability Facility, which essentially is a repo facility which is trying to intermediate capital between long-term and short-term. I do believe, and we heard, I think, Larry Fink in this morning's discussion again, talking about the need to deepen the capital markets, because what we also need to do is provide more instruments so that one can actually spread risk. And today we don't have enough of the risk-spreading instruments in the emerging markets. And so essentially, we have very few instruments to do many more things than we need to do. And so it's a very, very good question. I think it's really if we could deepen the capital markets and spread the risk with new instruments. And we don't have to reinvent them. I created a repo for emerging markets just because I looked at what BNY was doing. And I've created an Africa index because I looked at what JP Morgan was doing with its emerging market index. But all of these things would drive capital to the developing countries. And I think we need our MDB institutions to also begin to create some of this capital market deepening instruments to allow for the $1 that you put to be able to go to $10. Now we're saying 1 to 4 with guarantees, but with the private sector, with a deeper capital market system, you can actually do 1 to 10.
Great. Well, I'm really sorry that our time has come to an end. It's been a really amazing, fascinating conversation. I really hope that we can join people in this room who are interested in following up with all of you, and also with the Sustainable Markets Initiative. Marc-André, you mentioned this translator function. I think the SMI really tries to do that really well when we're bringing the industry perspective, the finance perspective, and the country perspective, as well as the MDBs. Like, how can we really be practical? How can we not waste the year ahead? Because we've got 5 years to deliver, and people around the world are looking for hope, and the private sector is a huge opportunity to deliver that. So thank you all for this session, and thank you to the Berlin Global Dialogue. Thank you.